Good afternoon, everyone. Welcome to Smarter Retirement Planning for Business Owners webinar presented by PACE and Westpac Wealth Partners. Today is the second session of the retirement planning series, and we'll talk about retirement plans for established companies. My name is Jeannie Yang, and I'm a business and loan counselor at PACE. Thank you for joining us today. This webinar is brought to you in partnership with the City of LA, Economic and Workforce Development Department, and BusinessSource Pico-Union Westlake Region, operated by PACE Business Development Center. This webinar will be recorded, and at the end of the webinar, we'll be asking you to participate on our survey. So please make sure that you complete the survey because it's going to help us plan our future webinars in better ways. And before we begin, I'll briefly explain about PACE. PACE was established in 1976, and we are a 501 nonprofit organization. We are a community development organization that creates economic solutions to meet the employment, education, housing, environmental, and business development challenges for the diverse communities in Los Angeles. We offer one-on-one business counseling, your financial plan development, and even your business plans to establish your new business or to help your existing business. And we can also guide you through the procurement contract if you're interested. And the greatest fact is that all our services are free. So if you have any questions about our products or our services, please visit our website, pacelabdc.org for more information. All right, our guest speaker today, Charbel and Daniel. Gentlemen, thank you for joining us today. Let's begin.
Thank you for having us. Daniel, do you want to introduce yourself real quick and then we can get started?
Yeah. Hello, everyone. My name is Daniel Alvarez, and me and Charbel work for Westpac Wealth Partners. I'm actually one of the advisors under Charbel's team. I've had the opportunity and the pleasure to present to all of you guys last year, and I wanted to bring in Charbel to, bring in an extra, head of resources and just to bring you guys extra resources and value and education. And so also just some housekeeping items. Do you guys have, if you guys can also please, try out the Q&A. We love for you guys to ask questions. Feel free to interrupt us or just type it in the Q&A. If you guys could just test it out really quickly. If you guys could just put your name and where you guys are coming from, that would be great. And Charbel, go ahead.
Thank you. Thank you, Daniel. I always love to have these webinars. I love PACE and what they've done with the business owner community. I come to you as a former business owner. I was in the restaurant space for 18 years with my family. So I know where you're at trying to, put out all these different fires. So today our conversation is going to center around the retirement planning. If you didn't join us the first time, I'm just going to briefly go through some initial plans and some initial considerations, but most of the conversation today will be based around the 401k. And basically that's usually established, not necessarily, but usually for businesses that are already established and have some employees. I'll explain that there are also options to open a 401k as a solopreneur. But really some of the things to consider is as a business owner, one of the things, and I was a client of the firm for 10 years before I joined them as an advisor, is as a business owner, it's extremely essential to have a coordinated type of planning. So we'll talk just briefly about that. We'll talk about the importance of being financially organized and what that means. The interaction also between the business and personal. So you are in such an incredible advantage because as a business owner, there are a lot of strategies that you can utilize that other W-2 only employees cannot utilize. And so it's important for you to understand the interaction between your business balance sheet or the business finances and your personal finances and how to be able to efficiently move money back and forth. We'll talk about the Secure Act 1.0 and 2.0, and then we'll also talk about, Cal Savers. All of us, I think, on this call are from California. And so, what the requirements coming up in January 1st and what you can do. And again, like Daniel said, please feel free to interrupt with any questions. This is not your typical Zoom. This is a Zoom webinar where you won't be able to chat, but you'll be able to ask questions. Let me just make sure to leave the Q&A on here. All right, perfect. Thanks, Ray. Pleasure. I was just in Torrance this morning. Long drive for me. It was a lot of traffic. All right, so the traditional approach is you as a business owner having to have these different agents and advisors and taking care of these financial decisions in silos. And what I mean by that is when you want to go to create a retirement plan, oftentimes the conversation goes straight to either your payroll company or a person that just specializes in retirement plans. What we try to do at Westpac is we try to have people understand that every decision that you make from the business owner space, every financial decision that comes up has certain ripple effects, and it goes beyond that particular category. So, for example, if the retirement plan is what you're planning to put in place, it is a bigger conversation from a retirement planning for you, for the business, employee loyalty, taxation, potentially legal issue, legal considerations as well. So we feel as a firm that every decision has some sort of ripple effect across your financial world. So it's our job to educate and give you the pros and cons with us and your other team of advisors. So on the bottom, you'll see kind of the approach that we try to take where we become the certified, financial, the CFO, right? The officer of your financial world. And the decisions that we try to help you make, our job is to give you as much resources, information for you to make smarter financial decisions by putting this team of advisors together and connecting with the rest of your group. So that's from the traditional and the more coordinated type planning. And then from when I say financial organization, so when we build the financial website, a lot of times our business owners know what they have. Most of the time they know where it's at, right? But the problem is how they all interact with each other. And so again, the importance of not operating in a silo, not just from a business owner perspective, but from personal finances. Every decision that is made has ripple effects. And so we need to discuss the pros and cons from all of those categories. And that's where we put together either, people that we've connected with in the past and we've done business with, or people in your network that you trust that we could bring into the team. We already talked about the personal and business finance. All right. So what is Secure Act 1.0 and Secure Act 2.0? The Secure Act 1.0 was a few years ago. I believe it was in 2020. It established a lot of tax credits for business owners. What people realize, or what the government realized, is people aren't saving enough for their retirement. And so as a result, they knew that that burden was going to have to come down to them. And as a result, they implemented these tax credits for new plans. One of the burdens of a 401k was administrative costs, they help issue tax credits for new plans. And I'll tell you a little bit about that. Actually, I'll tell you now. So you can get up to a $5,000 tax credit in year one on starting a 401k. Depending on the number of employees that you have, that should almost be enough to pay for all of the plan. And whatever you don't is not covered, you can also, it's a tax deduction for the business. Secure Act 2.0 came a few years later, a couple of years ago, and it added even more tax credits. So one of the tax credits that were added, and I'll discuss later, is a tax credit for employer contributions, and I'll tell you how that works later. It also gave older Americans a chance to kind of catch up their retirement contributions a little bit faster. It put in place certain requirements for business owners. So now when a business starts a 401k plan, you have to opt out as an employee. Before, it used to be where the business starts a retirement plan, sends an email to all the employees. If they wanted to join, they would opt in. So starting next year, every plan is going to have an opt-out clause. Basically, everybody will be automatically enrolled, everybody will also be automatically enrolled in increasing yearly benefits, and that generates a tax credit as well. Secure Act 2.0 also gave the ability for business owners to give some student loan matches to their employees, and along with establishing the SEPs, and I'll talk about the SEPs, but the Roth version of the SEPs in simple. So just briefly, I want to talk first about CalSavers. I'm going to go a little bit out of order here. CalSavers is the program where the state of California is requiring businesses to have a qualified retirement plan. And so they started with employers that had 50 or more employees, then they did 25 or more, then they did 10 or more, then they did 5 or more. January 1st, it will be a requirement for any company that has at least one non-owner employee to have a qualified retirement plan. And so CalSavers is run by the state. You log in, you set up your business, and then you put your employees, and then it sends them an email, and then it gives them an opportunity to contribute to their own retirement account. There's no match on you, there's no cost to you, and it satisfies a requirement. We like to take that a little bit step further, and I'll show you when we talk about 401ks, is we want to be able to use the retirement account, not just to satisfy a requirement, but to also help you with tax mitigation, and as well as helping you build a retirement for you as the business owner and your family members. So there are ways to structure that. The IRA, or the individual retirement account, that is one that it's just an individual, it's not employer sponsored, and you can open up an individual retirement account and you can fund it $7,000, or if you're over 50, you can go to $8,000 this year. And that's going to go up slightly next year. But again, that does not satisfy the CalSaver requirement and is not considered a qualified retirement plan. The SEP IRA is a simplified employee pension plan, and so that could be set up as a sole proprietor or a different company. And if you have employees, whatever you put for yourself, and these are all employer contributions, so the company puts that in on behalf of you as an employee and the other employees there. It's based on what your Schedule C income is, or if you have a W-2, based on a percentage of a W-2. If you decide to put 10%, then you have to put 10% to every employee that's there for you. There's certain qualifications. They have to work for you 3 out of the last 5 years. And this does qualify and satisfies the CalSavers requirement. And a lot of times a SEP does work great. It low cost, it accomplishes the requirement, and it gives you an opportunity to put away money for you. But it just gets a little bit trickier when you start having employees, because on a year you do well, if you want to put 25% away and your employee makes 50,000, well, that's 12,500 you got to put in for them. The simple IRA, which was the answer years ago to the 401k, they were trying to make it a little less administratively burden heavy and a little cheaper. But as a result, or in my opinion, it's a lot more complicated than the 401k, from not necessarily from an administrative, but from what you can and cannot do for employees. You are required to do a company match in a simple. So they are slowly moving away from simple IRAs into 401ks now that 401ks are more affordable. All right, so I'm going to switch gears here, and I'm going to go to my whiteboard. So we're going to talk real briefly about how the 401k works. So 401k is considered a trust. So what that means, if I have a company called ABC Inc., okay, and ABC Inc. is going to open a retirement plan or a 401, an employer-sponsored retirement plan. So I then hire a company, they develop this adoption agreement that tells who can join, when they can join. Just think of it like a contract, but that has to abide by ERISA, which is a federal law that says about discrimination towards certain employees. So it has to abide by ERISA laws, extremely important. And the fact that it's a trust gives it that protection. So if you remember O.J. Simpson, with the millions and millions of dollars that he owed the Goldmans, his 401k and his pension from the NFL were protected because of ERISA laws. So that in case of lawsuits or other things, nobody can touch your 401k. Now, once the trust is set up, there are three ways that money goes into the 401k. Once the money goes in, it goes into your different employees. So we say participant one, participant two, and participant three. So Daniel, Jeannie, and I are participants of the 401k. Initially, we have an employee contribution in the form of a salary deferral. So every year, as an employee of the firm, even though I'm an owner, I am allowed, if I'm under age 50, to put away $23,500 into my 401k. Once I put that in, it goes into the 401k and then gets credited to my account. If I'm over 50 years old, there's a catch up of 7,500. If I'm between the ages of 60 to 63, there is an additional, well, the catch up, if I'm at that age, is I believe 11,250. So it allows me, as the older I get, to catch up because the government realizes, or even I realize, hey, I'm a little bit behind. Let me try to catch up. So that comes out of a paycheck at the end of the month. That's why, as a business owner, it's extremely important if you're an S Corp or LLC to tax as an S Corp to give yourself a paycheck. Because if you just take distributions and don't do a paycheck, you are not able to do 23,500. You actually can only do 90% of whatever you pay yourself. So it also depends on how you're structured as a company, what type of plan, and there again is the interaction in this case between tax and legal structure. The second part of the 401k is called a match, or excuse my writing. And there are a couple of ways to do the match. This match is not required. So here's where it gets a little bit tricky. If you want to be able to put in 23,500, the IRS requires you to do something called a safe harbor match. If you don't do a match and just do the 401k, and I have 5 employees, and each employee only puts in 1% of their income, I will then be restricted to only putting 1% of my income. If you don't want how much your employees put in to affect how much you are able to put in, then you implement something called a safe harbor match. The safe harbor comes in 2 forms. The first one is a 3% non-elective, meaning every one of my employees, including me as an employee, they're going to get 3% from the company, no matter whether they put $1 or they don't put $1. The second one is up to 4% match, meaning if I put in $1 as an employee, the company puts in $1 on my behalf. If I put in 2, they put in 2. If I put in 3, they put in 3. And then after, the next 2% is at half. So if I put in 4, they put in 3.5. If I put in 5, they put 4. So the maximum that a company would have to match, even if I put 80% of my income, is 4%. And so one of the things about the match is that it is 100% the employee's money the minute it's in their account. So for example, a client or an employee has been working for you and you have a holding period of a year. So after a year, they can join the plan. They make $50,000. 4% of that is $2,000. And so as a result, you have to give that person $2,000 for that year. If they decide to leave the next day, you are obligated and they can take that $2,000 and take it with them. One of the cool things that the government did with Secure Act 2.0 is that they issued something called an employer matching contribution credit. And what that allows the employer to do is, if Daniel and Jeannie were my employees and I put in $1,200 for each of them, I am able to get up to $1,000 back in a tax credit for each employee as long as that employee is not a highly compensated employee. So it gives me an opportunity to increase employee loyalty and at the same time to have it not cost much out of my pocket. So the employee sees it as me giving them 1,200, but it only cost me 200, and even that 200 is tax deductible. I'm looking at the questions, so I don't see any questions here. The third part, and I'm just going to delete this. The third part of the money that can go into a 401k is the profit sharing option. So the profit sharing option, they call it discretionary, meaning you don't have to put any money in there in the profit share. But if you have an incredible year, there are opportunities that the employee deferral, the match, and the profit share can add up to $70,000 as of 2025. So you're able to add in your 23.5 of salary deferrals plus the match plus a profit share. And it could be structured and designed to be more advantageous to you as long as it meets all of the testing required by ERISA laws. So that, in a nutshell, is just a little bit of how the 401k structure is. I'd like to go back to the slides and show you who are the players in the 401k. Again, I know there are a lot of players here, but when you're starting a 401k, you're able to hire one company that does most of these things together. It's called a bundled product. So the first choice to a lot of business owners is their payroll company, Paychex, ADP, Heartland, whatever your payroll company is, they'll have some sort of a retirement plan that's connected to it, and they have all of these services, which I'll go through a little bit. Before I get into that, I do want to tell you that if you are a solo entrepreneur, you have the option to open up a solo 401k. So you still need docs, but they're much cheaper to put together. And, it could cost $300 to $350. And it will give you the ability to put in the 23,500 as an employee and also have your own match and the company match it, and then also have a profit share attached to it. This gives you the highest flexibility because since there are no other employees, you can decide how much you want to put away. And the other thing to add is these 401ks, they have the option to have a Roth option or a traditional option. And the Roth option is where your money is taxed it's after tax money that goes in, but every dollar taken out is tax free. I'm sure many of you have heard of Roth IRAs. Roth IRAs, once you start making a lot of money, they are no longer able to contribute to them because you hit the income limits. Inside of a 401k, there is no income limit to the Roth 401k. And that's something that we see a lot of our clients that they have it, whether it's their employees of other jobs, but they don't realize that they're actually able to contribute to the Roth portion. And again, we talk to people and we try to figure out, okay, what's best? Is this year Roth or traditional? Because each year your tax rate will be different. And so do we defer the taxes or do we just pay the taxes now so that Uncle Sam is not involved in any money? If you want me to go deeper into the difference between Roth and traditional, please let me know. Otherwise, I am going to go back to this slide, which gives us the players. Obviously, here you are the employer. Obviously, you and your employees are the participants. In this particular case, it could also potentially be children and spouses if they're on payroll. The third-party administrator is considered the CPA of the retirement plan. So every year when you say, if Daniel's my employee and I told Daniel, or according to his paycheck, I put in $1,200 on his behalf from a match, the third-party administrator is the one that confirms that the $1,200 that I took that I put in for his match and the money that Daniel took out of his own paycheck was properly inserted and deposited into his own 401k. That's the part that you want to make sure that any money you put in on behalf of the employees is in their account or even the stuff you take out of their paycheck is in their account in a timely manner. There's a law, I believe it's 7 business days that money has to be in that account. So the third-party administrator, just think of them as the compliance officer of the 401k. The record keeper is the one that keeps all of the records of the 401k, has participant information. The custodian is the financial institution where the plan assets are held. And then the 338 fiduciary is the one that decides on what funds are inside the plan. We usually just pick a 338 fiduciary, so a plan just gives us the funds. We don't have to sit there and choose. And then the 316 fiduciary is basically just plan operations. If you hire a new employee, they keep track of when that employee becomes eligible. So the custodian, the third-party administrator, record keeper, fiduciary, and both fiduciaries can be one company. So basically, it would just be one company here, you and us. That's the idea. And sometimes you don't need us. The reason that you need us is for the education and guidance of the participants. So basically, if there was no financial advisor on the plan, you as the business owner are assuming educational liability, and that's something I don't think any owner would want to do. Same thing, that's why we have a fiduciary, is neither you or us want to assume the investment liability because we're not keeping track of the performance of every single fund. We hire a fiduciary to do that. So as long as you have the investment professional for the education and those two fiduciaries, there's no concern for you, because any client or any participant that comes to you with any questions, you're going to easily direct them to the fiduciary that's responsible for that. You as an employer should never, ever answer any financial questions. Which fund should I pick? What should I do, Roth or regular? If an employee comes up and asks those questions, those are not your responsibilities. So the less liability or the less responsibilities that you have, the better for you. You have other liabilities in your world, in your businesses. This should not be one of them. So as long as everybody's abiding by their duties, then the plan should run smoothly from there. One of the advantages of the 401k, and most of our clients decide to put it, is a loan provision. So if your employee or you have an IRA somewhere from an old employer, one thing that you could do is once you open your company's 401k, you could then bring in those assets inside to your company's 401k, and now you have access to it via loan. And the maximum loan, according to ERISA and IRS rules, is 50% or $50,000, whichever is less. So if you have 80,000 in your 401k, the maximum loan is 40,000. If you have $1 million of your 401k, the maximum loan is 50,000. So those are the participants and the players, I want to say, inside of the 401k. Not all TPAs are created equal. So basically, if you go to Paychex 401k and ask them to give you an illustration, which takes your employees, their ages, and their incomes, and basically comes up with the least amount of money you would have to put in to the employees while maximizing your portion. And then you turn around and you go to a different 401k provider, those illustrations will most likely look different. Because a third-party administrator, what they do is they send in their specific formulas to the IRS for approval, and different TPAs have different calculations and formulas and how they determine their illustrations. I don't know why it's not all uniform. It would make our job a lot easier. But if that's the case, then we could always go with an unbundled product where the TPA is somebody different and everybody else stays the same. So those are opportunities where we want every dollar going into the 401k from the company to go to 90 cents of that dollar, or 80 to 90 cents of that dollar we want to go to the business owner and their employees. Because you're still giving them that 10%, 20%. You're deducting it, and you're also creating a retirement plan that the employee could be happy about, that they're getting some money from you. And so they're less likely to go out and look for another job, because most of the other jobs that they're going to look are going to have a retirement account for them. So if the pay is the same, but I get a match with somebody else and I don't get a match with you, odds are I might most likely going to leave you. All right. And we go back to, oh, apologies. The other part of the retirement plan is the defined benefit plan. So I just want to go through that just very briefly. There are potential opportunities where a business owner can create both a defined contribution, which is a 401k, and what that means is that means that it's defined by the IRS how much you can contribute. That's where the 23,500 comes in. The other type of plan is called a defined benefit. And a defined benefit is very similar to a pension, where, back in the day, if you worked for GE or Ford and there was a pension, so you worked there for 40 years, at the end, actually, we still have pensions now with police officers and firefighters, TSAs and other government employees, where once they retire, 90% of their, income, or the highest 3 years of income, they're going to get back for the rest of their lives. And so while the defined contribution tells us the max that we can contribute, max contribution limits, the defined benefit plan works a little bit differently. And the way that it works is it works backwards. It works trying to determine the benefit according to what you make today at age 62, works backwards. We have put in clients that have put away $400,000 to $800,000 a year in tax deductible contributions on behalf of the company in their accounts. So these plans can get really impressive. And so we will talk about a little the defined benefit plans in further details down there. Now, as a company, you are able to have both a defined contribution and a defined benefit. And the advantage of that is if you give the employees enough money in one plan, it might leave the other plan free for you to put in whatever you want, or even a higher amount that you would otherwise be able to do. So what's called cross-testing, they are tested against each other to make sure that you are not discriminating against, file and rank employees, that you're not just putting all the money for you and none of it for them. Once all the testing is passed, then the defined benefits can actually then be cross-tested against the 401k and produce, you never know. If the business starts booming, you might need those contributions in particular years, and you're able to do that. Now, something cool to also realize is that the 401k, you have until tax deadline of next year to implement the 401k for this year. Meaning, if you file your taxes in, September of 2026 for 2025, you do the extension, you are able to, in July of 2026, if you realize you're having a phenomenal year, to go back and do these retirement plans retroactive to the beginning of 2025. The only thing you won't be able to do is do any salary deferrals, because your W-2 numbers are already set, your employees' W-2 numbers are already set, so you would not be able to do any salary deferrals. But the match, the profit share, and a defined benefit plan all can be done retroactively for a year before. So many of our clients, as they get closer to tax deadline, realize they have a bigger tax liability than they thought, and will use this opportunity to shift money from the business to the personal assets in a very tax efficient way. That is all I have for today, Jeannie. We didn't get as many questions today as we did last time. I see some familiar names on there. But
Yep.
any questions, comments, or concerns? One of the advantages, and just one of the names here triggered, one of the advantages is if you are the sole owner, right? And let's say you have 1099 contractors, or you have union workers, or you have other people that are technically not on your payroll, or even staffing agencies that are, giving you the employees. it gives you tremendous flexibility to set the retirement account the way that you want, that works for you and your family and the business as well. So just wanted to kind of put that out there. But any questions, comments?
So Shabelle, when you say solo entrepreneur or solo owner, what kind of business entity does it apply to? Sole proprietorship or LLC with a solo manager or
Yeah,
member?
any
It could be any
structure.
type, any
Any
structure.
structure. The only times that it matters, Jeannie, and that's a great question, is what your income is based, like how your income is determined. So as a solo proprietor, and again, I'm not a CPA, just from, the experience of working with a lot of them. If you're a sole proprietor, or an LLC taxed as a partnership, it's your Schedule C income, because you don't technically have a W-2, you just pay self-employment tax, and it's whatever you have 100,000 in revenue, you have 10,000 in costs, so your 90,000 is profit. It's based on 90,000. That's how your deferral could be determined off that. You're matching the profit share. If you are an S corp, there should be a payroll there. So maybe you could get away with no payroll 1 year, but the CPA is going to tell you you're going to need, I need to see payroll. And then that one is based on W-2 when you're an S corp or a C corp, right?
Okay.
Or even an LLC taxed as an S corp. So
Right.
again, it all depends on what structure you are, what determines. And so every year towards the end of the year, we're getting together with our business owner clients and their CPAs, because most of the time the CPA wants a minimum reasonable salary. Sometimes we want them to bump that up because that triggers a lot of other deductions next year, right?
I see.
So the same
Yeah.
there's a question here. Is there a limit of how much one can put into a 401k as a solo owner? It's the same limits as these ones up here. It is depending on your age, but if you're under 50 years old, it is, I'm going to switch to red. Oh, it didn't switch to red. It is 70,000 as of 2025, I believe. And that's a combination of salary deferral, the match, and the profit share. And then you're able, so you're able to do that. If you're a husband and wife, you could both have solo Ks, because a husband and wife are considered, the ownership is still considered one owner. So you're able to have a solo K for you and a solo K for your wife or spouse.
So is it going to be separate account or same account?
Separate account.
Separate account.
Yes. Yeah, separate account, but 70,000 each person can be put in.
Okay.
Yeah, so it starts adding up. So as a single member owner LLC, sorry, I just switched up. Okay, as a single member owner LLC taxed as an S corp, how much could you put towards a 401k? So again, that is the 70,000 number, but it also is dependent on your W-2. If you have no W-2, then you would not be able to put in anything from 401k, and you'd have to ask a CPA, but I'm pretty sure, because it is based, you need a payroll. So as an S corp, one of the advantages of having an S corp is to bypass self-employment tax, but the government wants that self-employment tax, and that they get that in with you in a form of a W-2. So if you have no W-2, you cannot contribute anything. That's why it's important in November and December to figure out what that W-2 number is or should be. We have a lot of our business owners just bump up their W-2s at the end of the year if we feel like they're having a good year. Because as a business owner, you're getting paid payroll or K1 or a combination of both. If I take 100,000 in payroll and 200,000 in K1, that's 300,000 to my pocket. Obviously, I'm not taking into account any taxes, payroll taxes. But if I switch the way I'm getting paid and I take 200 in payroll and 100 in K1, at the end of the day, it's the same net to my pocket, maybe a little bit less payroll taxes, but it could be taxed completely different. And then it could trigger incredible contributions on one side more than on the other side, if that makes sense. So a lot of times we're telling the CPAs, hey, can we shift this? Tell us how it works, because most of the time CPAs are reactive. they're looking at last year and this year. We're looking a little bit further ahead into kind of, minimizing the tax. I'm the sole owner of an S corp. My office employees are not interested in a 401k, but I am interested in myself. What is the best way to contribute to a 401k? You would do the 401, if I was you, from the limited information that I have, Valerie, you would do the 401k with the safe harbor match. Because if they don't contribute anything, you don't have to match anything. It allows you to put in the 23.5. You qualify for the, you satisfy the requirement, and then you're able to do a salary deferral and potentially profit sharing and a match for you. So that's how I would like it. That's kind of not a bad scenario because you're giving them the option to, and they're choosing not to, so you don't have to match. All right. If as a single owner of a C corp that has, I'm assuming that's K1 without salary for a hardship year, can you make up a contribution? Can you make contribution to any plan later? Okay, so you're a C corp. So, but the C corp, Ray, if you could just give me a little bit more detail, because as a C corp, you're already taxed on the corporate money. So as a C corp is not a pass-through entity, so you're taxed at the corporate level. And then from there, are you taking any salary or not? Which I didn't understand the question, and I'll put it here just so in case maybe Daniel, or if as a single owner of a C corp that has K1 without salary for a hardship year, can you make up a contribution to any plan later?
Yes, that
Again,
means not having a good year this year, but later on when there's profits for the company, then can you make up for the plan like retroactive?
so you can do it, except I'm not understanding so I'm assuming no salary. And so again, that's based on W-2. So I would have to look at it. I'm not sure the answer to that, Ray. Um, to be honest with you, we don't have a lot of, so just out of curiosity, Ray, and maybe we did this in a couple of webinars ago, but is there a reason why you're a C corp? Is there a specific reason? Because as a single owner, you're just trapping the income there, retained earnings, you kind of get double taxed by paying the first at 21%, and then any income you take there is considered a dividend. So there's double taxation there, unless you're planning to go public or get, some foreign investors. That could be the reason why, but it might actually be a conversation to see if that's the right structure for whatever business it is. But I haven't seen a single owner C corp before. I've seen it where there's a lot of partners and there's going to be some seed money and different money raises in the future and a big sale in the future. Sorry, I hope that answers that, Ray. Any other questions? We're happy to have a conversation. Let me give you our
Contact
again.
information.
Yeah, so you could just click the QR code on the right, gives you access to my calendar. Daniel and I, oh, there's another question. So, Chijoki, is it recommended to match a 401k? So it depends what your goal of the 401k is. If the goal of the 401k is just to satisfy a requirement, maybe the 401k is not for you. But if the goal of the 401k to maximize your retirement while still giving you an opportunity to give something to the employees and have some tax deductions, remember there's two safe harbor options. There's the safe harbor match and the safe harbor non-elective. So if you feel like your employees are all going to put in a lot of money, then you would do the safe harbor non-elective. If you feel like your employees aren't going to put a lot, then you do the safe harbor match. If you want to be nice, you would just probably put in the match. And if they put in, great. If you're asking to do the safe harbor or not safe harbor, again, that would really, really limit what you're then able to put in. And so for us and the business owners that we deal with, they want to save for their retirement. And that's one of the better ways to be able to use that product to help move money from the business to the personal balance sheet. On the left side is a financial scorecard. It's a kind of like a little summary, and it'll give you a scorecard at the end from assets, liabilities, protection. It is confidential. We don't get that information unless you press a button at the end saying, yes, please, help me, but it'll give you kind of red if there's a gap, yellow if there's moderate gap, and then green if you're kind of on track.
All right. So if you like to listen to today's webinar at a later time, again, which I recommend, the recording will be available at under our website, PACE LA BDC, under e-library. All right. Any other questions before we wrap up?
Let me see.
Yes, that's
There's
about
stuff in
it.
I'm sorry, oh, that's you in the chat.
Uh-huh. That was me.
Oh, okay.
All right. So thank you, Daniel Charbel, for a great webinar. I learned a lot today.
Yeah. Thank you for having us. We're a resource for you and your group of amazing business owners. So anything we can do, let us know.
Thank you so much. Folks, please make sure to join us next week, same time, Thursday, November 20th, 1 p.m. We'll conclude our series, and it's about advanced retirement planning strategies. So make sure you join us for that webinar as well. That's all for today. Until then, bye, everyone. Have a great rest of the day.
Everyone.
Thank
you, everybody.
you. Bye.
Bye-bye.